It's June, and that means we're nearly halfway through 2018. Volatility continues to sway global markets in the second quarter, and tariffs trade and the Fed may be at the tip of our tongues, but has the investing landscape really changed? And when we hear disruptors, we may think technology, but it's not always tech, and it's not only FANG stocks. Joining me now at the NASDAQ market site to talk about the big picture is Joel Litman, President and CEO of Valens Research. Joel, great to have you back again.
Thank you, Remy. Thanks.
Well, it is June, and that means we're taking a look at the Fed as well as trade and tariffs. But when we take a look at the big picture, fundamentally, what has changed and what hasn't?
Yeah, it's despite all the tariff talk and the saber rattling, from various political elements, we are still witnessing the highest quality and the highest level of earnings power we've ever measured in corporate America in maybe 60 plus years. With that, we've started to see companies start to spend in growth and innovation, which is also very strong fundamentally, not just in the US, but also abroad in certain parts of the world where we're also measuring such great returns. And combined with what we're seeing is also the healthiest credit environment we've measured in a long time. We measured the credit default swap, which is years ago was around 660 plus. It's the rate of the cost of debt above the risk-free rate. That fell to 390, from 660 to 390 in an aggregate high yield CDS. Since then, the stock market has risen around 70%, and now we're measuring it around 200 CDS. It's a very healthy financing environment for growth, for innovation, for companies, and it really means that the S&P 500 is bound to go up, not just likely, but really inevitable over the next 2 years plus.
Mm-hmm. And now that we've gotten your take of the macro picture, I do want to move on to disruptors. Now, usually when we talk about disruption, we might think about the FANG stocks or at least Silicon Valley when it comes to innovation. But it's really difficult to invest in those names if you're just starting out, and they are becoming expensive. So where are you seeing the opportunities right now?
Yeah, we've relied on our research and research with the IXL Center. A colleague, Dr. Hitendra Patel, has done some great work in this area, and it helps us really to find the winners and losers in disruption and the ones that benefit from the opportunities. If there were another Google or another Amazon, like in the real estate space, I'd have to say that's Zillow Group, ticker ZG. What they're doing with the algorithms behind the scenes and running what they're doing for real estate, both residential and commercial. And what they're also doing in the community and the network. They recently did a contest to improve their algorithms, and I think 4,000 data scientists submitted entries, and they eventually picked the best one, which actually improves their algorithms. And then finally, they're tracking behavior of customers to such a degree that they really can be helpful in predicting and understanding what consumers want and what they need. We contrast that with some REITs like Kimco and DDR that have seen their stock prices get cut by more than half over the last many years. And part of the reason is they failed to innovate. They've stuck with strip malls. They haven't urbanized the way age waves have gone. It's not always disruption from technology. It can be disruption from the millennials and what they're buying and where they're spending. To that extent, an interesting real estate play would be actually Planet Fitness, which you might at first not think is a real estate play, but given the best is the enemy of good enough, what they've built for just good enough gyms that take up a massive amount of square footage in a lot of these malls and strip malls which are just empty, they're being courted to actually enter those malls and at phenomenal rates because they can take up so much of the space that's been emptied out from the retail apocalypse, if you will, that's been caused somewhat by Amazon. So I think Planet Fitness, I think, is a great opportunity. Speaking of Amazon, there's been a lot of talk of what Amazon's done to retail and what Amazon's done to other industries, but I think people haven't yet seen there's a small for Amazon, but it's already $500 million. Amazon Basics, Amazon's move into private label brands should have every fast-moving consumer goods and every consumer products group really on notice, because that's the next area where we might see things really happen. When we talk about winners and losers, I think we're going to end up seeing a lot of losers in that area if they're not very careful. Amazon Basics, I think, is growing 80% a year in private label brands. So I know it's not a real estate play per se, but it's certainly a derivative of what we're looking at in terms of what to look for.
Well, Joel, I think that's very insightful because we're continuing to see changing behaviors due to technology when it comes to consumers, whether it's in the retail space or how people go about conducting their daily lives. So I do want to move on to the telecom sector. When we last met, we had just heard the agreement between Sprint and T-Mobile. So it does seem as though the space is dwindling in terms of players, but where are the opportunities right now?
Yeah, again, I'll mention the research from IXL Center, and one of the things they say is when you spend on innovation, which we want to see, you want to spend in small bites, if you will, right? Start small, find something that's proven, and scale fast. And I think Sprint has really needs a merger because they've taken on so much debt over so many years, from backing WiMAX and backing things that just didn't work out, in the tens of billions of dollars, versus spending in innovation in smaller ways. I think AT&T and Verizon have done a better job of that overall. Frontier Communications is another one that I think has gotten a lot of problems in going the wrong direction in where they've taken their big bets from an innovation standpoint and not gone more urban and not gone into the areas that one would hope. So, the problem in telecom is that it's such a competitive space that it's hard to find a high conviction, long idea. There's an adage, don't buy the companies that are going to war, buy the arms dealer. And so one that we really like is Cirrus Logic, ticker CRUS. As a supplier to telecom equipment, especially in particularly the audio space of telecom equipment, we think it's quite inexpensive. We think they're quite innovative, and there's a lot of upside for Cirrus as a derivative play on what we're seeing going on in telecom.
Well, interesting perspective, Joel, and I haven't heard WiMAX in a while, so that does sound pretty retro. But I do want to move on to financials now that we've covered telecom. Now, in terms of financials, we might be taking a look at how they're performing as a sector or how recent fundamentals such as the Volcker rule are affecting the landscape. But when it comes to disruption, what are you seeing?
Again, some of the credit card companies, and one that I think is really like and should be on everyone's watch list, if not their long list, is Capital One. They've done a good job from just being more of a credit card company to really moving in banking over the years. I'd contrast that with American Express, which is a credit card giant, but really has not moved into banking the way we've seen Capital One do it and providing more of a full suite of services. And so at the end of the day, you want that innovation to service the customer and be there and watching which ones are innovating in a way that the customers need and moving their business model around appropriately is where we'll see the winners and the losers. In this case, COF or Capital One versus Amex.
And I think when I think about innovation in the financial space, I might think about mobile payments or what the big banks are doing in terms of paying attention to the millennial crowd.
Yes.
Now, last but not least, I do want to get your take on what to expect going forward. It's so easy to get carried away with what's happening in the broader market, whether we're talking about the equities or commodities or treasury yields. But in terms of sentiment, what do you expect to see?
There's a lot of good research around sentiment, investor sentiment, and what have you. One of the things that we've done differently is look at management sentiment. And we actually track the earnings calls from quarter to quarter of management teams, noting how the change in tone, the change in what they're saying, the change in how they're saying it is moving over time. And while investor sentiment, and there can still be a lot of pessimism, there's a lot of I'll say financial media that talks about problems coming. From a management team perspective, not only have they been very excited and I'll say growingly so in their confidence over what they've been doing and the great earnings that we've been seeing, we're also seeing a lot of confidence in terms of spending and growth and innovation almost in every sector we measure. And that's a very, very good sign. It's very bullish for the economy. It's very bullish for the sectors that we've seen this. And it's very bullish even for the companies that I've mentioned, because in each of those cases, we've seen such strong earnings call momentum, if you will, from a management sentiment standpoint.
And last but not least, before I let you go, since you did mention earnings, now that we're done with the prior quarter's earnings season, were there any surprises overall?
I think we could be surprised at how well top line and bottom line went over the last earnings season. And now that we've been able to digest all those earnings calls from the last quarter, I'd say that it bodes well for the next quarter. I think the next quarter we're going to see more of the same. It's going to be very strong, and it's very bullish for the markets, not just in the near term, but for the longer term. I think we have a great buying opportunity now where the headline risk has created a little bit of market correction for us to get in for the next 2 to 3 years.
Okay, Joel. Well, thank you so much for joining me today at the NASDAQ market site, and I look forward to our next conversation.
Thank you, Remy.